I'm Jeffrey Stevens with Florida Retail Scholarships, and today we're in for a real special treat in our Masterclass series. We have Chen, President and CEO of Saglo Companies. They're a South Florida development company, and they purchase properties, re-tenant them, add value. And Hugh's going to talk about some different loan structuring techniques. Hugh's been with Saglo for over 15 years. He's a graduate of the UF Master's Program in Finance.
I graduated UF undergrad in 99, and I'm actually talking about fund structures as opposed to loan structures.
Just go take it away then, Hugh.
A lot of the stuff that I talk about can be seen on my YouTube channel, Hugh Chen CRE. So I have a bit of a library of content on there now. But today we're going to talk about real estate fund structures, important things to consider, including waterfall structures. I think this probably hits home with a lot of the real estate students out there, since I actually happen to go to all four major university-led real estate conferences every year. So FSU has their Trends Conference in Tallahassee. University of Florida actually has theirs in Orlando as opposed to Gainesville. FIU has theirs in Miami, and then University of Miami has theirs in Miami as well. And I could tell you that I would say the curriculum leans heavily towards the analyst capital markets side of things for a lot of the schools. So I think this will probably hit home for many of the students. It's going to be a fairly advanced class, so take a lot of notes. When you're raising a fund, it is a private placement. So you are raising money not publicly, and all of that does fall under the SEC. And specifically, it falls under Reg D, Regulation D of the SEC. And within Reg D, you can raise money in two different ways. 506B, which is kind of the original way that was started in 1982 when SEC came out with Reg D, or 506C. Which is what came out in 2012 through the Jobs Act. The difference between 506B and 506C, what that allowed for is general solicitation. And what is general solicitation? That's essentially posting it on your social media that you're raising money. It's putting it in newspapers, magazines, radio ads, but probably more internet type related, because after 506C was passed, then that's where you got a lot of crowdfunding, because crowdfunding in itself, they're marketing towards the masses that are going to invest smaller amounts, 5,000, 10,000, 50,000, as opposed to 100,000, a million, 5 million, right? And so that's a key differentiator. Another differentiator between 506B and 506C is the way that you accredit. In both cases for private placement, you're wanting essentially accredited investors. And accredited investors is a definition or a defined term in the SEC that essentially says, hey, this grouping of people are sophisticated investors. And if you're dealing with these sophisticated investors, you have some protections as a GP, because they should know what they're getting into, or should be able to read the documents and know what they're getting into. So what's an accredited investor in the eyes of the SEC? It is, and I encourage the students to look it up, but the accredited investor in the eyes of the SEC, the vast majority of people qualify in two ways. One is that you have a net worth of at least $1 million, not including your principal residence. That's number one. Number two is that it's an income qualification, that as a single person, you are making at least $200,000 a year for the last 2 years and expect to make $200,000 a year every year going forward. As a married couple, that bar is $300,000. So that's the primary way you're going to get accredited. And just to reiterate, we take accredited investors only. So when we're talking to potential investors, we're always asking, are you accredited? And the reason why is for our protection. If you take on unaccredited investors that are deemed not knowledgeable enough to get into private placement, then the risk is that if your deal goes south, right, you don't hit your projections, a lot of tenants leave your property all in the same year, and you have to give it back to the bank, and you lost all of your investors' money, By the way, we've never done that. So in 50 years of Saglo, we have never, ever done that. Track record's really important. But if you did, if you had unaccredited investors, they could sue you and say, look, how dare you lose my money? I had no idea that that was possible because I am not sophisticated enough to know how to invest in a private placement. They could do that and they would win. So that is why you want to stick with accredited investors. And that's why there's a lot of people that are out there unaccredited that says, hey, why can't I invest in these great return type of assets and funds? And it's really for the protection of the GP. Let me do a screen share because I'm actually reading off of some notes here. All right. So everybody can see this, right? So you got SEC, Reg D, Rule 506B, 1982, 506C, 2012. Definitely look it up. And we do actually register with the SEC. I can tell you, like, not to name names, but there's a lot of people that do start funds that don't register with the SEC. That's common. It's a compliance thing, but I would say it's not like you have to re-register every year. Let's just say if you didn't register, like, people wouldn't find out unless something went wrong. And they're like, oh my gosh, this is a private placement. They never registered. And so it's a little bit of self-governing, but the consequences of you not doing it are fairly severe. So you definitely want to do it. When you're starting a fund, it starts with a general partner, right? So I am part of the general partnership of all of our funds. Myself and Jack, who's my partner, before we start a fund, we have to think about a lot of different things. And this is applicable for anyone starting a fund. The first thing is, what type of assets are going to go into the fund? For us, it's shopping centers because we spent 50 years really focusing on shopping centers. But not only shopping centers, we said, all right, we're not buying enclosed malls. That's out of our buy box. We're not doing street retail like Lincoln Road or Fifth Avenue or anything like that. We're definitely not doing that. Additionally, we aren't going to upmarket. So we're not buying low cap rate, very sexy properties like with Whole Foods and Publix and things like that. That's one asset type. And within that asset type, you're dialing into perhaps a more narrow focus of what within that asset type. But it could be apartment buildings, and you could say, look, I'm doing only garden style. I'm not doing high rise. It could be built to rent. That's popular now. It could be office buildings or medical office buildings. It could be industrial, light industrial, small bay industrial, et cetera, right? Then you have to think about how much money that you want to raise. And a lot of that has to do with what you can actually deploy and then how much time do you have to deploy it in, which I didn't write that down here, but that's a very important consideration. So the typical deployment time is about 2 years. A lot of times when you're raising a fund, you're saying, look, I'm going to have 2 years to deploy it. I've heard 3. I rarely hear less than 2. So somewhere between 2 to 3, could be 18 months sometimes. And then you have to think about how much leverage on average you're going to be putting onto your properties. Are you leveraging 50%, 60%, 65? In our world, you rarely see it leverage above 65%, and which means that you need to raise 35% of the purchase price as equity, in addition to the transaction costs and the cash reserves that you have up front. So those are all things that you have to reserve for. And so if you think about the type of assets that you want to buy, what you think you can actually buy in the next 2 years, how much leverage that you are trying to put on there, you can reverse engineer and say, okay, I want to raise 20 million or 40 million or $50 million. And my average property that I'm going to be buying is about 10 million. And since I'm leveraging 65%, that's $3.5 million of equity just from the LTV standpoint, right? But then it's going to be another 250,000 in transaction costs and another $500,000 in cash reserves. Cash reserves means that, if there's a lot of vacancy there, to lease up the vacancy, a lot of times to do the deal, you need tenant improvement allowance and leasing commissions. And also, when you're buying the property, especially if you're not buying a new property, it's a fixer-upper, you might need cash reserves for a new roof, a parking lot, new paint, new landscaping, and those things. And so if you add that all together, you might say, look, every one property is about 4.5 million of equity, and I think I can buy 4 of those. So maybe my fund size will be about $18 million. That's kind of how back of the napkin it. And then you have to think about how long you want to hold. We hold for 7 to 10 years, but in reality, when it comes to the year 10, if the properties are still good, if the communities are still strong, and we still see a future in those assets, we will talk to our investors to see if they want to go for an additional 7 years. It's just that a lot of people don't want to invest in something that has no end date at all. That being said, there's also a lot of funds that do shorter hold periods like 3 years, 2 years, 4 years. And those are kind of your burn and churn type of funds that are the equivalent of house flippers, but for commercial properties. And what happens there is you actually have higher IRR, internal rate of return, because when you look at the IRR formula, the time factor is probably the factor that governs how high or low the IRR is the most, right? So if you double your equity in 7 years versus 3 years versus 10 years, that IRR looks very different. So the hold period and the way that the extensions work. So ours is 7 years plus 3 1-year extensions, but we do have an ability to exercise a larger extension of an additional 7 years, and there's some rules around that in our subscription agreement. Also, what you want to think about is how much as a GP that you want to put into the fund. So we put 20 to 25% of the required equity into the fund, which is on the high side. So that is a lot of skin in the game. Let's go back to our $18 million fund example. So in $18 million, if we were to put 25%, we're putting in 4.5 million of that 18 million. I would say that a lot of other funds I've seen anywhere as low as 2 to 3% to 5% on the low end. And I do know that there are a lot in our peer group that do put in 20 to 25%. I can tell you that private investors want to see that the GP has skin in the game because there's a high alignment in the success of the assets, and that the GP is not just cash flowing only off the promote structure, right? Another thing that you want to think about is your fee structure. So that comes up a lot in investor discussions, and they want to know, well, what's your acquisitions fee? Is there a dispositions fee? Is there a fee when you put a loan on the property? What's your management fee? What's your leasing fee? Is there an asset management fee? And you have to segregate what is property level fees like leasing commissions and property management fees, and what's fund level fee structure like asset management fees would be a fund level fee structure. Acquisitions fee would be as well. And on the property level, especially for shopping centers, a lot of those property level fees actually do get passed through and reimbursed by the tenants themselves. So the investors don't feel it as much. But the other fees on the fund level side, that's going to erode what the investor gets. But those fees are necessary just to keep the lights on for the manager, right? But sometimes they do get egregious. So you have to just make sure that it doesn't look like it's too high. It's okay for the GP to take fees to support its infrastructure, but really they want the GP to make most of their money off of the promote, meaning that if the properties perform above certain expectations, the general partner gets more money, and that's the best way to do it. You also want to talk about capital calls, how those work. So the way that we do our funds, and let's say our 2021 fund, we raised $40 million. And at the time of closing, we may have deployed 40%. And then the next property that we buy, we might have deployed 20%. So the way that it works is if you're investing $1 million into that fund, I tell you that, look, you're committing $1 million. It's not like you're sending me $1 million check the time that you signed the subscription agreement. You're committing to it. It just so happens when we start funds, we always seed it with a couple properties because we buy ahead of the fund. In that example, at the signing of the subscription agreement, you're sending in 40% of that $1 million. So you're sending in $400,000. Then when we buy the next property, in the due diligence process, if we think we're going to close, we're going to give everybody a 30-day heads up. Hey, we're under contract. We already started due diligence. We think we're going to close on this deal, and be prepared to send in 20% of your committed capital. And so that kind of how it works. There's also capital calls after the fact, meaning that you raised all the money, you bought all the properties, and 3 years down the line, you need a new roof and you don't have enough cash reserves. And the new roof costs $1 million and you only have about $200,000 in cash reserves. That $800,000, where does it come from? It can come from a few places. You can try to borrow additional money if you have enough equity in the properties. You could take it out of cash flow, or you do a capital call. And investors hate capital calls after the fact, for CapEx type of stuff. You're also talking about how is capital returned? Is it returned, as you're distributing annual yield in the life of the fund, that quarterly distribution or monthly distribution, is that yield or is that return of capital? Majority of the time it's yield. In some cases, I've seen that all of that's treated as return of capital until all the capital is returned, and then there's some sort of waterfall after that. I have seen that, but I think for tax purposes, that might have a different type of tax implication. But more often than not, the yield is the yield, and when the capital is returned is during capital events such as refis and sales of properties. Then you want to talk about distributions and catch-up distributions, meaning that there's really detailed as far as how the cash flow is distributed when the quarterly payments are to be sent out. So actually, I'll show you. All right, so this is our subscription agreement. This is for our 2019 fund. This is probably about 100 pages long. And for example, it spells out in great detail in that all net proceeds are going to be distributed in a specific manner. 100% of the proceeds are distributed to the Class A members. Those are the limited partners until such time that the Class A members has received all of their preferred returns, including any time that in the past, if you weren't able to pay the preferred return, there's a amount that you have to catch up until you're able to surpass it. So you always get your preferred return. So first is that Class A members until they received the preferred return. Then after that, in this case for 2019 STC, 75% above the preferred return after that goes to the Class A members, and 25% goes to the Class B members. When there's a capital event, then you know that the Class A members have to be caught up with their preferred return first. Then anything above that is a return of equity. And once all the equity has been returned, then it's 75% to the Class A and 25% to the Class B. So just to give you an example of the type of detail that you might see in a subscription agreement. Then there's clawback. So our subscription agreements do include clawback, meaning that if there's been promote paid in the life of the fund, but then something goes south and the fund itself never hits the 8% preferred return, but then promote was paid earlier on, we do claw it back so that the GP doesn't make any promote if the fund never hits the preferred return. What else? So I showed you a little bit about this subscription agreement, and within the subscription agreement, it's all the things that I talked about. So all of those details about the fund, including the accreditation verification. There's a survey that's there, and I'll show that to you. I'll actually go over the subscription agreement. So the subscription agreement, this is the legal document that's actually binding everybody, right? And it talks about in detail the offering, how much money that's being raised, the term, how the promote structure works, and all of that. And then as exhibits, you have a questionnaire. And the first exhibit would be a questionnaire on how you qualify as an accredited investor. So it'll ask you questions like, when you're investing, how are you investing? Is this tenants in common, tenants in entirety, tenants in common with spouse? As an individual or as an entity? Is it a trust? Is it a benefit plan investor? Is it a collective investment trust? So there's all these, or other entity. So there's all these questions that you have to answer, and then based on that, it is determined whether or not you are accredited. And if you have a CPA, you can just have your CPA fill this out as well. Then in addition to that, you have so you can see the questionnaire gets pretty long. A W-9, that's what's needed for us to send out the distributions. Then the term sheet. The term sheet is really a summary of of everything, of all the terms of the fund in an easier to read format, less legalese. And then you have your limited, this is your LLC agreement. So that's part of it. So you can see all of that. You can see the attorneys make a lot of money putting fund documents together on page 60. Then you have your joinder, securities law, and other legal matters. So all of that's in there. I mean, like everything's in here. Property related information. And so we actually just attach our pitch book to this as a property related information. So in this particular case, it is 3 properties: Goldenrod Marketplace, Maze Crossing, and Gateway Station. Although I don't think we had bought Gateway by the time we raised this particular fund, and it just gives you a little bit of data on the properties themselves. And I think that is no big one here. So risk factors. One of the things that we really focus on in our subscription agreement is just to tell the investors all of the risks that can occur in investing in a private placement fund. You just have to be very transparent. You could lose all your money. That is a possibility. There could be death of the GP. That's a possibility. There's a lot of things that can happen that are outside of the control of the GP. And there's environmental, there's a pandemic, there's all sorts of things that could happen. So there are like 10 pages of risks. All right, let's go back to here. Okay, so a little bit about waterfall structures, and I can maybe, let me open this up actually. So this is Gateway Station. This is a property that we had acquired in 2019. We bought it for $15.8 million. We put up 200,000 in TI and LC reserves. We got 4 years of interest only, so we didn't reserve any CapEx money upfront because we're gonna, take it from the increased cash flow available for distribution, since we had interest only the first few years. And then there's a lot of transaction costs, including our acquisitions fee. This is our loan, and you can see that all populates into a fairly robust cash flow analysis tool. And year 1 projected cash flow before debt service of $1,090. Our debt service was $447,000 because it's interest only. When you're, including principal pay down, it would have been $686,000. So you can see that there's a bit of a difference. And a lot of banks will give you interest only if you have some vacancy there, or if there's some real value that you're trying to create and you need that additional cash flow to pay for that. And that was the case here. So, which shows you that if you have $1,090,000 of cash flow before debt service, your debt service of $447,000, that means you have $642,000 of cash flow for distributions. Out of the $15.8 million, the equity part of it was $6.125 million. And you can see that where that came from is that, if the loan is $10,586,000, you need $5.2 million just as 35% of the purchase price. But then there's a number of transaction costs that you have as well. So that totals to $6.12 million. $6.125 million times 8%, that's our preferred return hurdle, is $490,000, which means that the first $490,000 is going to the Class A member. And $642,000 is greater than $490,000, so I have enough to pay my preferred return right off the bat, which is usually the case if you're buying at a good spread between cap rate and interest rate, and especially if you have interest only. Since I have excess cash flow above the preferred return, in this case, I can apply my waterfall of 75% of the excess amount, so that's $642,562 minus the $490,000. You have $152,562 of excess cash flow. And then 75% of that goes to the LP, the Class A members. That's $114,000, and the rest goes to the GP, $38,000. So that's a really simple waterfall structure. Now, There's other different waterfall structures out there. I don't think I'll have time to kind of go through all of them, but maybe I'll describe them. I've seen preferred returns of 6%. I've seen them at 10%. I've seen that after the preferred return has been reached, I've seen 50-50 split. I've seen 75-25. I've seen 80-20. I've also seen that the first 1% after the preferred return has been met goes to the GP and then the split. So let's just say the preferred return is 8. Once you hit 8, between 8% and 9%, all of that goes to the GP. And then after that, there's a split. I have seen preferred return that's more based on an IRR, meaning that if your project hits above a 12% IRR, then there's a certain split until it hits a 14% IRR. Then there's a even more split until it hits a 16% IRR, with the incentive structure being that if the GP's really pushing to increase the returns, then the greater that they increase the returns, the more money that they make. So that is an alignment, or that's a way to drive the GP to perform stronger. Anyways, that's 30 minutes. I have time for questions.
Hey, Hugh, can you hear me okay?
Who's this?
Hey, my name is Andrew Lewis. Hey, good morning. Thank you for your time and for being here. I'm just walking a job site, a renovation property right now, so that's why I'm not on camera. But I wanted to know, for the document that you just showed us, the 100-page document, is there any way we could get access to something similar to that, current or old one, or if there's a public company or site that you recommend checking out to see something like that?
So public companies fall under Reg A, where this is private placement, so that's Reg D. And I can't share ours. It's just proprietary. You might be able to find one if you Google enough, but they're just really not out there. Nowadays with ChatGPT, you can ask ChatGPT to create one for you. The structure will be probably good enough to learn from, but you might not want to use it in practice. You probably want to hire a fund attorney to make sure that it has all the belts and suspenders that you need.
Gotcha.
Hey Hugh, it's Sandy. I have a quick question for you. Somebody is not accredited, but let's say they're close. Could you just have them sign like an indemnity or something so that it
No.
protects you? No.
No, it's just not worth it. I mean, if they're not accredited, it's likely they're not putting in a tremendous amount of money to begin with. And then to take on that risk for that small of an investment just would be ill-advised.
And do they only enter into these agreements personally, or can it be an entity or trust, you said?
It could be, it can be an entity, a self-directed IRA, it could be personally, it could be a trust, revocable trust.
And
Hey,
you said you
I'm
had a YouTube channel. Can you just tell us what that was again?
Yeah. Here. So actually, maybe I can pull it up on my share screen.
While we're waiting, are there any other questions? Do you have any questions? Anybody have any questions for Hugh?
I have a question.
Sure.
Hi.
Hey, Karina.
Hi, Yuskulin. Thank you so much for the presentation. What is normally the required return that you recommend for a waterfall structure? What is the
What is
most common?
what is the so I always recommend people read the book. Here, let me grab it. Give me a second. Let me stop share screen. Okay, so can you see this book?
We saw it for a second, then it disappeared.
This is the Gary Rappaport book, Investing in Retail Properties. And this book is what we modeled our fund after. And so what Gary does, he's an ICSC member and he's based out of Washington, D.C. And his funds are single property syndications at an 8% preferred return and then 50-50 after that. I think the 8% number kind of is very sticky. I would say that would be the most common preferred return that I've seen. The split after that, there's a lot of variation. 50-50 would be good for Gary because he's been doing this for 40 years. So he has a huge track record and people are willing to accept 50-50. But, just starting out, you might be at a higher split to the investor.
Okay, thank you.
Good deal. Any other questions?
Hey, I have another question. Could you talk a little bit more about how the process was and the experience was for raising your first deal, the challenges, and I guess the mindset that went into that?
So our first deal was in 2013, and it was a single property syndication called CVS Plaza. It was a small deal. We bought it for about $4 million. And I was doing leasing for the first 12 years of my career. And this was my first acquisitions as an acquisitions person 13 years in. When we bought the property, we were kind of building the plane as it was flying, right? We were putting the pitch book together. We were learning more about Reg Ds, especially the 506 Bs and Cs. We had some friends that were starting crowdfunding platforms because it was the Wild West at that time. Legislation had just been passed to allow it, so everyone was creating one. During the course of our ownership of it, from buying the property to potentially getting ready to raise money, we had some changes in the tenant mix. I had a restaurant. My largest tenant is a small deal, 18,000 square foot deal, but I had my 4,000 square foot restaurant turnover at a daycare. That was my second largest tenant. They were not happy with various things with outdoor playground and stuff like that. So we're kind of fixing things as we got along. And the long story short would be, or the long story long would be, that we ended up not raising any outside money. It's just Jack and I on that deal. But during that time period, we kind of, it was a small deal, which is good. We learned a lot about the process. So then our actual deal that we brought in outside money was our second attempt. And so there's a lot more to it than you think. So maybe doing a dry run with a small deal might not be a bad idea.
Very good point. Anyone else?
I got
Okay.
another question for you. So right now, my mother and I are doing different investment property projects, and it seems like to scale, we really need to do the 1031 exchange process. So could you tell me a little bit more about how, I'm assuming you did the 1031 probably to maybe get started, and I want to know now, are you still doing that, and how important is that?
Yeah, I've only done the 1031 once, and it's that same first property that we bought, CVS Plaza. We bought it for $4 million. 2 years later, we sold it for $6 million because it was in Miami. Miami got crazy, and we were able to 1031 into a property in Tampa that was much higher yielding and much larger. It was a good opportunity, a good like-kind exchange. I would say that the danger of syndications and funds with 1031s is that in a 1031 structure, the ownership structure has to remain the same. So meaning that if you sell a property with just you and your mother and you want to buy another property, you can't also bring in outside investors. That's not allowed.
Thank you.
Okay, well, I see we're out of time. And Hugh, we're grateful for the presentation. And if you'd like more information, you can reach out to Hugh directly or visit his YouTube channel, Hugh Chen CRE.
All right, everyone, have a great rest of the day. Thanks for joining.
Thank you for your time, everyone. Have a wonderful day.